Hello students, today we are going to discuss about retirement accounts, how they will be treated as per your tax angle in US taxation. Topic of discussion is individual retirement accounts. There are actually two types of retirement accounts in US. First one is your traditional IRA. IRA means individual retirement account. Second one is your Roth IRA. So normally if you are a salaried person, if you are receiving a form W2 wage statement from your employer will do some type of retirement plan for you like 401k etc. You can also contribute individually to the retirement accounts. So that is what we are going to discuss. We are not going to discuss about employer plans. Okay, your 401k and all. Traditional IRA means you will contribute to this account before your tax dollars, before tax payment. In the sense, you will contribute before tax amount. So let me explain you a little bit with little bit more clarity. So contributions to traditional IRA will be done as above the line adjustments to your taxable income. For example, if your wages, salaries, whatever income you have, income is let's say $50,000. Okay, so you made a contribution to traditional IRA $5,000. Okay, so the once you minus this, whatever you are getting, $45,000, it is your adjusted gross income, AGA. Okay, on this AGA after credits and all you will pay the tax. Okay, so traditional IRA means you are contributing to the retirement account using your pre-tax dollars. Okay, dollars which are not tax debt. So this is the example. Roth IRA means contributing to the retirement account. Contributions will be done to the retirement account, IRA account, with post-tax dollars. It means whatever contribution you are making to Roth IRA, it won't be allowed as a adjustment to your gross income. So you have to contribute from this 45,000, not from your 50,000. Okay, this is for Roth IRA. That is the main difference between these two, traditional and Roth IRA. We will discuss that in even more detail. Okay, there are some rules and regulations. Before that, you can make contributions to the individual retirement accounts. So there are annual limits. Annual limit. Any person, they can contribute only up to $7,000 to any IRA account, whether it is traditional IRA account or Roth IRA account. Remember, this 7,000 limit is not applicable for your employer sponsored plan. Okay, where you will contribute to something and the employer will match the same amount, like your 401k. Okay, so now we will discuss about another one called traditional IRA. This limit extends to $8,000 if you are 50 years or more. This is the annual limit, remember that. Okay, so now we will go and discuss about traditional IRA in detail. if you want to compare this with India, you know your PF, Public Provident Fund, PPF, RPF, etc., and EPF, Employer Provident Fund. EPF is actually related to, it is not same, it is your it's like your 401k in US. And traditional and Roth IRA you can compare with your Public Provident Fund, etc. Fine. Traditional IRA rules. Okay. Traditional IRA you can contribute up to $7,000. Okay. This is yearly limit. This is made with pre-tax dollars, and you can get deduction up to this limit if you or your spouse is not covered by employer sponsored program. It means if your employer, okay, if your employer doesn't have any retirement retirement savings programs, then the entire 7,000 will be given to you as a deduction, whichever status you are falling under. But if you are covered by employer sponsored program, then your deduction limit is restricted if covered by employer sponsored program. So how much is the restriction and all, we'll see now. Okay. So even if your one spouse, let's say you are filing a joint return with your spouse, even if one person is covered by employer sponsored program, then the deduction limit is restricted. Deduction, this is the above the line adjustment. Okay, remember that. For single status persons, the limit is 79,000 to 89,000 US dollars. For married filing jointly, I will explain it clearly how it works and all. The limit is 126,000 US dollars to 146,000 US dollars. For married filing separately, it is 0 to 10,000 US dollars. Okay. So how it is restricted and all, let me explain by taking one example. Okay. So if you are coming under single status, the limit I told is 79,000 US dollars to 89,000 US dollars. Okay. So if your income is less than 79,000 US dollars, you will be eligible for full deduction above the line adjustment, okay, of $7,000. Let us say if your income is falling under 79,000 US dollars to 89,000 US dollars, then you are eligible for only partial deduction, partial adjustment you can say. If your income is greater than 89,000 US dollars, there will be no deduction. This is for 2025 tax year. Remember, all the limits we discussed in the videos are for 2025 tax year. Okay. So you may wonder how you will get the partial deduction. So I will calculate by giving you one example. Let's say my income is 80,000 US dollars. So it is falling under partial deduction slab. Okay. So now we will calculate the eligible deduction for IRA, traditional IRA. Okay. How they calculate is, so how much income is more than 79,000? So first you will do your total income minus the lower limit 79,000 US dollars. So that will give you 1,000 US dollars. Okay. And what is the limit here? Limit is from 79 to 89,000 plus. So there is a limit of 10,000 US dollars. Okay. So you will divide this $1,000 with exemption not eligible percentage. You will calculate with $1,000, which is the income greater than your lower limit, divided by the range of partial deduction, which is 10,000 US dollars. So that gives rise to 10%. So you will not get 10% exemption will be withdrawn. So that gives rise to 7,000 minus 10% into 7,000 US dollars. That gives rise to 6,300 US dollars. So this is the above the line adjustment eligible for this particular person, single person. Same like that you can calculate for married filing jointly and married filing separately. So this is how the above the line adjustment works for traditional IRA. Remember, we are discussing only traditional IRA here. We didn't go to Roth IRA. Okay. Now, suppose let's say your employer is sponsoring and you have so much of money with you, and you want to contribute to this savings plan up to 7,000 the annual limit. Okay. You can contribute to traditional IRA. There are no restrictions for contribution to traditional IRA up to the annual limit of $7,000. Okay, even though you are not eligible to take above the line adjustment. Okay, so you can contribute with post tax dollars. Okay, there is no restriction on that. You can contribute the post tax dollars also. This is only for traditional IRA. Okay, so when you are making contribution, you are getting deduction, right? But when you are making withdrawals in traditional, the withdrawal will be treated as your income, means it will be taxed. Withdrawal from traditional IRA will be treated as income. Okay, so you have to pay tax on the withdrawals. Fine. Okay, so there are no restrictions on withdrawals and all, but if you withdraw before 59.5 years age, then you have to pay 10% penalty. Okay, suppose at the age of 50 you want some money and you want to withdraw from the traditional IRA. You can withdraw, but there is 10% penalty plus whatever amount you are withdrawing, it will be added to your income. Okay, there are some exceptions to this particular withdrawal penalties. Okay, one of the exceptions to escape 10% penalty for early withdrawal. This is applicable only for traditional IRA. Remember that. What is the first exception is for first home purchase. So you can withdraw up to 10,000 US dollars. And from 2025 tax year onwards, $1,000 you can withdraw for emergencies. medical emergency, etc. Okay, there are some other exceptions also, but this is required for your exams. Okay, very simple, no hard and fast rule, whatever we have discussed for traditional IRA. Okay, so let me show it to you again. Traditional IRA. So this is your traditional IRA. The annual limit is $7,000 US. Okay, deduction, full deduction is available if both you and your spouse are not covered by employer sponsored retirement programs. The deduction limit is restricted if anyone is covered by your employer sponsored program. How much is the restriction? We have taken one example and I have explained to you. Okay, so this is how the calculation works. And early withdrawals, there is some prepayment penalty. Okay, early withdrawal, some prepayment penalty is there, and you can escape the prepayment penalty for first time home purchase or some emergencies. These are the limits for escaping. If you withdraw up to this limit, there will be no prepayment penalty, and whatever amount you are withdrawing from your traditional IRA, it will be added as a income. Okay, so that is about traditional IRA. Now let us discuss about Roth IRA. Okay, this is also one of the individual retirement account, you can contribute to it. Remember, the limit of 7,000 or 8,000 US dollars is for both traditional plus Roth. Both put together limit is 7,000 US dollars. And Roth IRA, the contributions will be with after tax dollars. Means you might have already paid the tax on them, and whatever money you have with you after paying the tax, okay, income tax, that money you can contribute to Roth IRA. Fine. As you are contributing with after tax dollars, the withdrawals are exempt from tax. Any withdrawal you are making from Roth IRA are exempt from tax, but to get this tax exemption, there are some conditions which you should know. Condition number 1, the account is at least, this Roth IRA account is at least 5 years old. Okay, and you should withdraw only after 59.5 years age. Okay, so both conditions should be satisfied. And example, let's say you open one retirement account at 8 years of age. Okay, so this at this particular age you open one Roth IRA account and you completed 59.5 years. So once you complete 59.5 years, you can't withdraw because only the account is only 1.5 years old. So you have to complete the 5 years. So 58 years plus 5 years comes to 58 plus 5, 63 years. You can withdraw only after 63 years. Only after 63 years. Then only the withdrawals are exempt. If you withdraw before it, then you are taxable. This is example, okay? So you have to satisfy these two conditions at any cost. The account should be at least, the Roth IRA account should be at least 5 years old, and you can withdraw only after 59.5 years age. Then only you will get the exemption for the withdrawal amount. In traditional IRA, the withdrawal is added to income. Here it is not added to income, it is exempt. Okay, and Roth IRA account, okay, there is no condition for withdrawing it. Okay, you can keep it for your lifetime without any withdrawals. It means you can make the money grow in this Roth IRA account for your ancestors, not ancestors, sorry, for your children, okay, for your next generation. So no need to withdraw it, you can keep the account like that, and your whoever is inheriting your property, they can take care of it. But traditional IRA, there is a condition that you should compulsory withdraw the amount every year after you reach 73 years age. This is compulsory. Okay, so after 73 years you should withdraw it if you are contributing to traditional IRA. At any cost you should withdraw it. Okay, so this is about your Roth IRA and traditional IRA. I hope you understood the concept. So I told traditional IRA, whatever you are withdrawing, it is added to your income, right? So some people will do something called qualified charitable contributions, that we will discuss now. So I was discussing any withdrawal from your traditional IRA will be treated as income, right? So there is some concept called qualified charitable distribution. Okay, it means you can distribute your traditional IRA to, you can contribute to any charitable institution. Then whatever distribution you are making from the traditional IRA, it is not added to your income. It is exempt fully. To get the exemption, there are some conditions should be satisfied. First thing is you should be 70.5 years old or more. Okay, then only you can make qualified charitable distribution. Second condition is the yearly limit is, annual limit is 108,000 US dollars. This is for your 2025 tax year. You can't distribute more than this. And also, whatever distribution you are making, you can't take that in your hands and you distribute it. That is not possible. You have to directly give instructions to your traditional IRA account. Please make a contribution of this amount to charitable entry. The traditional IRA account should transfer the amount directly into charitable institution account, qualified charitable institution account. If that is not done, then it is taxable as your income. Okay, so the credit should be done from the traditional IRA account. Okay, you should not do from your own account. That is also another condition. So most people do it. So once you reach 70.5 years age and all, so you will think about charity. So that is what many big industrialists think about in US. So they do that to get an exemption. And I told the yearly limit as, annual limit as $7,000 or $8,000, etc. So whichever is limit is applicable to you. So what happens if you contribute more than that limit? So there is something called excise tax on over contributions to your retirement accounts. What is this excise tax? So how much amount you are exceeding, exceeding the annual limit, will be taxed at 6%. So whatever amount you are, let's say you are contributing $10,000. So extra is 3,000. 3,000 into 6%, you have to pay excise tax. So this is to restrict people to make over contributions. Okay, until unless that money stays in your account, every year you have to pay. Okay, so this you should remember for your individual retirement accounts. Now we will go to our material to discuss even more. Okay, this is our material. We will see now. So unit 9, individual retirement accounts. So traditional IRA is a retirement account where funds are generally not taxed until they are distributed. Means whatever you are contributing, that will be given as above the line adjustment. Okay. When they are distributed means you are withdrawing the amount, then it will be added to your income. So this was discussed. Roth IRA. Roth IRA are made with after tax income. Okay. And they are now never deductible. So whatever withdrawals you are making, it is tax free. And for that withdrawal, there are some conditions I have already told. The account must be 5 years old and you should be at least 59.5 years old. Okay. So now we will see the IRA contribution limits. IRA means individual retirement account. So for 2025, 7,000 is the limit. If you are 50 or more, 8,000 is the limit. Okay. Now we will see the traditional IRA rules. Okay. So it offers tax deferred growth where funds are not taxed until they are distributed. Okay. So deductibility, they are fully deductible if neither is covered by employer sponsored retirement plan. This was discussed. So while explaining the concept. But if covered by the plan, there are limits. So single and head of household 79,000 to 89,000 US dollars. Married filing jointly 126,000 to 146 US dollars. But if you are married filing jointly and one spouse is covered and one spouse is not covered, then the limit is 236,000 to 246. Here both spouses are covered. Okay. Now I already told, if you are contributing to traditional IRA, you should withdraw at the age of 73. This is compulsory withdrawal, and there are some exceptions for the withdrawal. Okay. This I have already told. Withdrawal penalties. So distributions made before 59.5 years age are subjected to 10% early withdrawal penalty. Okay. So there are some exceptions to this. First is your home purchase. Okay. So up to $10,000 they won't charge you this 10% penalty. Okay. Next, Roth IRA rules. I told Roth IRA are funded with after tax US dollars. Contributions are never deductible, so you can't adjust as above the line adjustment, but distributions are entirely tax free. Say there are some limits. Okay, income limits for Roth IRA. So if your income is in between 150,000 US dollar to 165, then only you can contribute to Roth IRA, or else you should not contribute to Roth IRA. It is not possible. Okay, these are your income eligibility limits. There are no income eligibility limits for your traditional IRA. Okay, so whichever income you have, you can contribute to traditional IRA, but Roth IRA, you are eligible only if your income is less than or in between this 150,000 US dollars to 165,000 US dollars. Married file jointly, you can see the limit there. So what people will do is, as there is no income limit for traditional IRAs, they will first contribute to traditional IRA, then they will change into Roth. Okay, you can see here, this is called backdoor Roth. Anyway, this was already discussed. Okay. So distributions from the traditional IRA are permitted at any time. They are treated as taxable income. So what they will do is, our exception to this taxability exception. So withdrawals are taxable, I told you. This qualified charitable distributions I have already informed. Some people will roll out to another retirement account. There is some plan called Section 529 plan for your children and all. So, okay. So for that there is no taxability. So these are the exceptions we have discussed. And I told you, traditional IRA, you should definitely take the distribution after 73 years of age. It is compulsory. Okay, or else there will be penalties. So qualified charitable distributions we have discussed. Okay, so taxpayers aged 70 and off or older may choose to make qualified charitable distribution, allowing them to donate up to the limit, annual limit, 108,000 US dollars for 2025 tax year. Okay, Tax treatment is this: whatever amount you are contributing to the qualified charitable entity, it will be excluded from the taxpayer's gross income. Okay, you can see here. Transfer rules, I told no, funds must be transferred direct, trustee to trustee transfer. You should not take it. Taxpayer receive the funds personally, then writes a check to the charity. It does not count as charitable distribution. If the taxpayer takes from their retirement account and they write a check to QCD, it won't be treated. It should be directly from traditional IRA account to the qualified charitable entity. Directly it should be there. Okay. Then only it will be treated as qualified charitable distribution and eligible for exemptions. Okay, so these are some of the rules for your Roth IRAs distribution. So Roth IRA, I already told you, they can keep for lifetime, so it will be inherited by your children. Okay, what are these rules? You can see it here. Roth IRA conventions. So next thing is, I told no, so if you are doing over contribution, there is something called exercise tax. So you can read it here. If a taxpayer contributes more than to a IRA than legally permitted for the tax year, the excess amount, whatever excess amount you are contributing, is subjected to 6% excess tax. Okay, so extra tax you have to pay. It is not worth it if you are paying 6% and whatever returns you are getting, it doesn't match. Okay, the penalty applies for every year till the over contribution remains in the account, whichever account you are asking. Okay. Although it can be avoided if the excess funds or any associated earnings are withdrawn by the due date of tax return. Okay, due date we have already discussed, April 15th. Fine. While the penalty is waived if corrected by the deadline, the earnings generated from the excess contribution must be reported. So whatever earnings you are getting from this Roth IRA, traditional IRA, they will be reported as taxable income. Okay. So this is all about your retirement accounts. So prohibited transactions, IIA investments. So normally what people do is, okay, so they open the traditional IRA account and Roth IRA account. They keep that amount in that particular account. Okay, they won't just keep that amount. They have to invest somewhere to get the returns, right? So whatever investments, this is strictly monitored by IIA. You can see here why IIAs offer broad investment flexibility. Okay, including, so they can invest in stocks, bonds, and even rental real estate. But some investments are legally prohibited, so IRS doesn't allow it. So like investments like your artwork, gems, stamps are not allowed. Metals and coins also not allowed. Gold and silver coins also not allowed. Okay, gold and silver coins are allowed, sorry. Most precious metals are banned. Personal real estate, you can see it here. Funds cannot be invested in life insurance contracts or S corporation stock. S corporation and all, that will be done in the business taxation lessons. Okay, so cannot be used to purchase real property for personal use. Okay, you can see it here. So these are some of the exceptions for your individual retirement account investments. So you won't keep money in the account itself. No, you will invest somewhere. So there is broader flexibility. You can invest in stocks, okay, gold and silver, etc. But there are some prohibited investment. You can't invest in this particular assets. Okay, so that is all about your individual retirement accounts. I hope you understood this concept. If you like this video, please like, share and subscribe. Thank you.